Chapter 1. Choosing a business entity. When starting a business, it's important to choose the right entity, as it can save significant legal, financial, and operational implications. There are more than a dozen different types of business entities, but the average small business owner chooses between sole proprietorship, partnerships, limited liability companies, and corporations. Each has its own unique characteristics and considerations. Let's start with the simplest form of business entity, sole proprietorship. A sole proprietorship is owned and operated by a single individual. It's easy and inexpensive to set up. However, keep in mind that the owner is personally liable for any business debts and obligations. On the tax front, the owner reports business income and expenses on their personal tax return. Next, we have partnerships. A partnership involves two or more individuals sharing ownership and responsibilities. There are general partnerships, where all partners are personally liable, and limited partnerships, where there are both general and limited partners. Like sole proprietorships, partnerships pass through taxes to the individual partners. Now, let's talk about limited liability companies, or LLCs. This business entity offers a combination of the simplicity of a partnership and the limited liability protection of a corporation. With an LLC, the owners are called members, and their personal assets are generally protected from business debts. LLCs have flexible tax options, allowing members to choose between being taxed as a partnership or a corporation. Lastly, we have corporations. C and S corporations are separate legal entities from their owners, providing limited liability protection. Corporations can issue shares of stock and have a board of directors. They can be more complex to set up and maintain, but they offer advantages like raising capital through investors. C corporations have their own tax obligations, and shareholders are generally taxed on dividends and capital gains, which makes it subject to double taxation. S corporations aim to mitigate this by functioning as a pass-through entity to avoid double taxation, but is only limited to a maximum of 100 shareholders. S corporations are often preferred by small businesses because they offer limited liability protection and can help reduce the overall tax liability of the owners. So, which business entity is right for you? It depends on your specific circumstances, including your goals, level of risk tolerance, and desired tax structure. Before choosing an entity, a business owner must consider these 5 things: liability protection, tax implications, operational flexibility, funding and growth potential, and succession planning. By carefully evaluating these factors and seeking professional advice, you can select the business entity that best suits your needs and goals.